This is the don't fuck this up rule book, and it's how to navigate these times. No leverage, right? Anybody with leverage has been blown up. No FOMO. So don't chase the peaks and don't sell at the lows. The further you are out the risk curve, the further your bag is down now. That's okay. I have SUI Solana as my main holding, so they're down more. Bitcoin is down less. You need to understand the risk curve. Then don't get fleeced. Don't lose control of your tokens by attaching some stupid website. Only have a small DJing bag. Remember when everybody thought that memes were going to be the biggest thing of all time? They've all gone to zero. That's because that's so far out the risk curve. It should be small and it should be there for fun, yet unlikely to make a fortune. The longer term time horizon is everything. Zoom out, remove the noise, and most importantly, expect 35% pullbacks frequently in Bitcoin. And that means more in alts. And buy the fucking dip if you can. So those are the rules, so don't fuck this up. Understand that as we go through the presentation, and you'll understand the opportunity set.
President Trump's tariffs are the only topic on everyone's mind for the past week. According to CNN, the Fear and Greed Index is at 4. To say everyone is freaking out is an understatement. Rumors are swirling that groceries will increase. Toilet paper will go back to $9 per roll like during COVID. And we are heading toward a huge crash because of this trade war. The stock market is down bigly, as Trump would say. But macroeconomist Raoul gave an emergency message to his audience. Raoul believes this is all down to demographics and the weaker dollar that China must have in order to function powerfully. Instead of fear, Raoul believes this is a beautiful opportunity to grow your portfolio and buy at a huge discount before the fall season comes. The fall season, according to Raoul, is when we will hit the alt season banana zone. This is a golden opportunity, and as Raoul has been saying for the past year, don't F this up. Let's listen to what Raoul has to say.
So zooming in where we are today, you can see that US total liquidity, so that includes the banking sector now, which is the new mechanism by which they're absorbing the debts and mandating banks to hold more government bonds. You can see it follows this debt to GDP chart. And here's the chart that drove the everything code. This is the interest payments going forwards. And here is liquidity rising to meet it. This is how you service the massive debts. You pay the interest. You do it via currency debasement. That's what liquidity is. It's a fancy word for currency debasement. And total liquidity is the way that they've been doing it. Now, this is not new. This was all done after World War II, when at the same time the world was massively in debt. We had lost a large part of the working population via war. And we then had to erode the debt via financial repression. Financial repression is when you keep yields lower than growth or lower than inflation, but generally lower than growth, nominal growth. And what happens is that over time, GDP rises, but debt doesn't rise as fast as GDP, and you erode away the debt. And that's via debasement. So that was very common in the 1950s. That lasted about 2 decades. We're about, where are we now? 2008. We're almost 2 decades into this episode. And interestingly enough, the S&P now very much follows the S&P in the 1950s. And what we had then was the everything code as well. We had this perfect 4-year cyclicality that plays out very similar to the cyclicality now. That cyclicality is the debt refinancing cycle. So in this stupidly colorful chart that nobody can read, and if you're colorblind, you're totally fucked. But imagine you could see it. You can see all of these colors, and basically each color is a year. And in liquidity terms, these are broken into seasons. So we're currently coming into the fall season, or autumn if you're not an American, because fall sounds stupid because what leaves fall or something, I don't know. But anyway, the autumnal season, and it's the nice autumnal color on the chart if you're not colorblind, is when you tend to see the main debts roll. So we've got about 9 or 10 trillion of debts to roll this year, and you need a large increase in liquidity. The last cycle, 2020, most of the liquidity actually came earlier because of COVID. But generally speaking, the liquidity cycle is this year. So we're expecting an expansion of liquidity. Now, there's various proxies for liquidity. Global liquidity is the important one, but it lags global M2, which is a faster reported series. Global M2 is driven a lot by the dollar, plus all of the private sectors and the government sectors around the world. So we found that these two have been really what matters. So when we think, now these are global numbers, everyone gets confused. The Fed are going to cut rates. It's irrelevant. It's irrelevant. It's this global liquidity that pays the global debts. Don't forget, 50% of the entire world's debts are in US dollars. That's one of the things that Scott Bessent has been talking about. Steve Merrin's ideas are about, is trying to reduce that. Good luck to that, but that's what it is. And it's the global cycle. So we know that the dollar is weakening. We'll talk about that later. That's a big part of this. We know that interest rates are coming lower, which is part of global liquidity and also part of financial conditions. We know that the US has been using a drawdown in the reverse repo and the Treasury general account. It will rebuild because of tax season coming now, but generally the US is injecting liquidity. It will not use the balance sheet yet, but it may well do later in the cycle. We need to see. But where the big game is to be played is China. China's balance sheet lags China bond yields. So if you remember, the US said, well, we won't ever get to QE until our bond yields get close to zero. Well, that's happening in China right now. They're in a full debt deflation. And China's going to be very important to this story. And it's the most important headline that is going to come is what the agreement is with China. So the agreement with China will be, and I've been talking about this for a year in Global Macro Investor and Real Vision Pro Macro, the agreement with China will be, you will agree to tariff terms. We will battle it out in public and make us look like we're all strongmen. You will agree terms because you have a dollar debt problem. The Chinese have a dollar debt problem and they need to service those debts. The problem is the RMB is too weak and the dollar is too strong. They don't have the cash flows in a slow economic environment to pay for it. They know, the US knows, Yellen even went to talk to them about it when she was still at the Treasury. They need a weaker dollar. Now, the mechanism by which China gets access to those dollars is usually via the euro-dollar market, and it's Japan that is the big driver of the euro-dollar market. So when we look at the weakening of the dollar, I like to focus on dollar yen to think of how this plays out. The yen is one of the world's big exporting economies, and it has a very weak currency. The yen needs to strengthen, and a strengthening yen and a weakening dollar will allow capital to flow into China and other dollar borrowers via the euro-dollar market. And the key thing that happens here is this chart of the Chinese currency against the yen. The Chinese currency was too strong versus the yen, and that has been putting pressure on Chinese exporters and the Chinese economy. It needs to rebalance lower, and this head and shoulders top and this head and shoulders top tell us the US, Scott Bessent, is going to get what he wants, which is a weaker dollar. A weaker dollar will stimulate global demand. It stimulates and allows for the rolling of global US dollar debts. It allows for exports and imports to free up. It allows for the movement of trade, even with tariffs. It's a very big deal, the dollar weakening. And if China can have a weakening yuan, a strengthening yuan, a weakening yuan against the yen, what it allows them to do is to compete. And that rebalances global trade and gets the global growth cycle going. So China headline risk to the positive side is the big one. Everything else is kind of noise because this is the big rebalancing that the world kind of wants. Everyone has a trade-off here. and everybody will come to the table for a trade-off, even China. But of course, everybody needs to look like a tough guy in negotiations, but something will happen and we will rebalance and we can move forward. This is exactly what happened last time when Trump was in power in 2017. What we had was called the Shanghai Accord. It was a kind of public, not public agreement to weaken the dollar to allow the Chinese to stimulate, because they need a weaker dollar to stimulate because they don't want to weaken their currency via the currency band, because if not, you get a devaluation, which they do not want. So that was the Shanghai Accord then. The dollar fell dramatically and the Chinese stimulated massively. If you remember 2017, the Fed were raising rates. They were shrinking the balance sheet, but China and Europe stimulated. And that was via this mechanism. So this time around, we've got the Mar-a-Lago Accord, which is some generalized understanding that an agreement has happened.
To watch the full interview, check out the link in the description. What do you think of Raoul's thoughts here? Do you still believe the banana zone is coming for the markets? Leave a comment. If you found value in the content, hit the like button, as that greatly helps the channel find similar viewers like you. If you're new to the channel, hit the subscribe button to stay up to date on the latest commentary on global news and markets. Thanks for watching, and we'll see you on the next one. SIM swap fraud is sweeping the globe, and your mobile security is at risk. Switch to Ifani and lock out SIM swap fraud and get the most elite mobile protection in the world. Ifani guarantees 100% protection from SIM swaps, backed by a $5 million insurance policy. Stay secure with reliable coverage, free international roaming, and unlimited data. Trust Ifani to keep your communications and assets secure. Get military-grade protection, 24/7 concierge service, and a hassle-free upgrade. Click the link below for $150 off. Thanks for watching. Help support this channel and receive exclusive offers from one of our partners located in the description. We'll see you on the next one.